Yeah.
Good evening, everyone, and welcome to the Brian Crombie Radio Hour on Saga 960. It's a real question in the marketplace today about where we're headed from an economic standpoint. The World Bank came out with some very cautionary comments recently, and someone who I really respect in the market, Hussein Ahmed, who is the president CEO of Yorkville Asset Management, recently wrote a paper called The Great Reset, where he goes through a lot of the different issues that are plaguing us in the market today, and where he thinks we're going. And I thought it would be helpful to hear it from him directly. Hussein, welcome to our show. How are you, sir?
Thank you, Brian. Thank you. Thank you for having me on the show.
So tell me, where do you think this great reset is headed?
Well, I mean, definitely a recession. The question is it going to be a mild recession that lasts 2 or 3 quarters, or is something going to be almost like the early 2000 or before, when we could enter into a period of a stagnation for almost like 2 years and maybe longer? That's the bigger question. There's a lot of things that are happening in the market that are worrisome, but also these present opportunities. If you are a buyer in the market, this is a great time to enter the market because everything is becoming cheap. So if you liked Royal Bank at a certain dollar amount, you'd like it even more now that it's cheaper. But the Great Reset refers to going back in time and retracing the market where we would have been if certain things did not happen. So first of all, the collapse of the Soviet Union, for example, brought what everybody referred to as the peacetime dividend. And that peacetime dividend, basically money was not allocated to war, nuclear armament, and money was allocated more toward bridging ties with the Eastern Bloc, and developing these emerging markets. The BRIC term became a regular term used, which refers to Brazil, Russia, India, and China. And that was the peacetime dividend. And from it came out of it the concept of globalization, the revival of the World Trade Organization. And many of you have read the book, The World is Flat. You drive through McDonald's, you put the order, somebody's India, answering that order and processing it, even though your drive-through is in Southern Ontario or in the US somewhere. So now what we have, the peacetime dividend is ending. Obviously, President Trump started trade restrictions on China. So this is the unfortunate sequence of events that we started this trade war with China, and then now Russia. So now we have 2 blocks that we're not on good terms with. Globalization, as we know it, it's ending, or at least for now, it looks like it's ending, bringing manufacturing back to the US or Europe. Western Europe is going to be an expensive venture, but it's also upsetting our allies, whether it's India, whether it's Vietnam, Malaysia, Thailand, where almost everything we own is produced in these things. So it's almost the death of the World Trade Organization, because the US abandoned the policy of dropping trade tariffs and opening trade across nations. So the US abandoned that strategy for whatever reason, politically more than anything, motivated. But now we are going back in time where we cannot benefit anymore from cheaply produced items in China, because even if China produces them at the same dollar amount, the US will impose tariffs to basically increase the price. And hence we have this inflation, because everything we do or consume relatively is imported from somewhere else. You know, we might buy an American car that's assembled in the US, but many of the parts or the electronics come from somewhere else. The chips that are in the car, the seat belts, the seats, the components come from somewhere else. So therefore, when you impose tariffs, all the prices increase. So people act as if they're surprised to see inflation jump to 7%. In many ways, we're fortunate that it's not 12, you know. So you add...
So you're saying, number one, the peace dividend is gone.
Yeah.
Number two, globalization, you say, is either dead or dying, and won't give us the low consumer prices that we've had in the past because of lack of global supply chains, I guess, and number two, because of tariffs that people are putting in place. And then number three, you're saying that BRIC countries that used to be this opportunity for major expansion, are because of wars with China and Russia, are now gone?
We don't have any friendly relations, trade relations with Brazil, with Russia, India, and China. I mean, India now is under significant attack from the West because it continues to import oil from from Russia. So none of these countries that we have traditionally relied on for manufacturing are as close as they used to be to us like 10, 15 years ago. You add to that the push that there is a feeling that we need to bring manufacturing back to the US, whether it's because the accusation that China is stealing technology or whatever the reason it is, bringing those production back to the US, we all know what's the average labor cost in the US or North America compared to what it is in China, Bangladesh, Pakistan, or Vietnam. So if you bring these things, naturally the costs are going to go up, and you're bringing them at the worst time ever because we're coming out of COVID.
So the implication of all this is higher inflation.
One key is higher inflation. That is now the major indicator that people are looking at in terms of the health of the economy. From inflation comes no economy can sustain itself at inflation rate 7% and interest rates at 1%. So naturally, either inflation has to drift down or interest rates going to go up. Interest rate is the enemy of the consumer, me and you, the same as inflation, because now we're going to pay more of our dollars towards mortgages, towards cars, towards repaying our credit cards. So that means we pay more on our mortgage. We can't spend eating outside, or we cannot buy more clothes, or we cannot go on more vacations. So that is threat number one to our finances. And interest rate is also key to valuing every asset. Every asset has an inverse relationship with interest rates. If interest rate goes up, the value of the asset goes down. If interest rate goes down, the value of the asset goes up. So think about it in terms of housing. Everybody in Toronto talks about how expensive the prices of homes are, but that's natural because interest rates the past 10 years have been heading down to close to zero. I think my last mortgage that I have was at 1.62%, and inflation is at 7%. I'm winning from this equation. So naturally, the price of the asset, which is the house, is now higher because people can afford more because interest rate is not a factor. But imagine what happens to a lot of people if interest rates or mortgage rates jump to 7%. That's going to eat away a lot of their disposable income.
Well, I want to ask you about what you think is going to happen to the different markets, real estate and others. But let's take a quick 2-minute break for some messages and come back more with Hussein Ahmed in just a minute. Stay with us, everybody. We'll be back in 2 minutes with Hussein Ahmed of Yorkville Asset Management. Welcome back, everyone, to the Brian Crombie Radio Hour on Saga 960. We're talking tonight about the economy with Hussein Ahmed, who is the CEO of Yorkville Asset Management, money management company in Toronto, someone that knows the markets extremely well. And we were just talking about inflation rates that have gone up and interest rates that you think must go up. So what's your sense? We've had a 50 basis point increase recently. I think most people think there's going to be another 50 basis point increase in July. What's your expectation for what's going to happen to interest rates the balance of the year? Are they going to go up to where inflation is, or halfway up, or is inflation going to come down?
Well, there's a economic thesis that inflation is a psychological measure. So as long as the Central Bank of Canada or the US Federal Reserve convince everybody that interest rates will continue increasing at an accelerated pace till inflation drops, they're going to continue doing that. Once everybody starts believing it and they stop spending, we will see the Feds or Bank of Canada easing out of raising interest rates any further. But definitely we're at least 1% to 2% away from reaching that point, because today we have a lot of supply shortages. And it's funny how the pendulum swings. So we have supply shortages. We have a lot of companies placing a lot of orders. So now what you're going to start hearing in the news, inventory buildup, because companies pre-order things in anticipation of this continuous boom. So you order more, GM or the car dealer across the street orders way more cars than they need, thinking that they're going to sell these cars. But now we enter into a recession, higher interest rate, higher financing costs, and we're going to start seeing inventory building up, and then inventory will cause that recession. So the pendulum is gonna swing from shortages to excess supply that they cannot move, at the same time higher interest rates. So they're gonna finance those inventories at a higher rates than what they've done in the past.
So if someone wants to buy a car, given your thesis, what someone should do is wait until interest rates have gone up, until where inventories have gone up, and then all of a sudden they slash prices as inflation comes down to try to release those inventory buildup.
Absolutely. I think now if somebody's trying to buy a car, it's a seller market, not a buyer market. We all hear the stories about used cars costing more than as if they're brand new. But if somebody waits about a year, guess what's going to happen? That car lot will have so many cars on it that they bought or ordered that they cannot sell fast enough, and they have to finance that inventory on the lot. So you're going to get a swing in the other direction. But what's going to be the caveat is where interest rates is going to be, because all of us, or the majority of us, will finance that car. So as long as the drop in the value of, or the deal you get on buying a car, we're using it as an example, is higher than the increase in interest rates, me and you as consumer benefit. But if this doesn't happen, if let's say the inventory buildup doesn't occur and interest rates jump to 4, 5, 6, 7%, then you're going to talk, and it's going to affect mortgages, car payments. The consumer is going to retrench substantially. And many people, in particular the millennials, they live on a paycheck by paycheck. There is studies about the baby boomers, for example, are natural savers. Millennials are not natural savers. They might be more natural investors, but they're not natural savers. They're willing to live with maximum debt, versus Gen X and baby boomers do not like that as much. We're not comfortable with it. So you're going to see changes in that, but we think it's a recession that's going to be harder to control, because on one side of it, it's supply related. And then as we come out of the supply, it's going to be demand that causes this recession. So it's kind of the double whammy. Normally, we're used to demand-driven recession, just a consumer pulls back because they're afraid of something, they're afraid of losing their job. Here, we're starting with a recession that's driven by supply shortages, and we're going to go to then the demand basically cooling off, which is what the Feds wants to achieve, but they'd rather achieve it relatively quickly in a shorter time frame, so they can start lowering rates and easing the economy into a milder recession. Right. That's what they want to achieve. That's what they're trying to manage. That's why they're raising rates aggressively, is that they would like to get to that slowdown at a faster speed, so that you and I don't feel it. And you'll hear it in the news. It was a recession for 2 quarters. By the time all of us wake up or come back from summer vacation,
the recession's over.
Recession is over, yes. But I think the situation now with Russia, with the war, with globalization, I think this has a little bit longer implications and structural implications on all of us. And it translates in how we invest, what homes we buy, how we save money, and all that stuff.
Now, just before the break, you were about to comment on the housing market in Toronto. So how does this recession, higher interest rates, currently high housing prices, how does that play in your prognosis?
Well, the natural assumptions or the natural math is the housing market has benefited the past 10 years from 2 trends. Trend number 1 is a gradual decline in interest rates over the past 10, 15 years. So that makes affordability index easier. People can afford bigger homes. So when we used to look at it in the late 80s, early 90s, when interest rate was around 9-8%, a person could afford a house worth $300,000. Today, that same person, same income, with interest rates and a mortgage at 1.6, can afford $1 million property. It has nothing to do with their income being better or lower. It's just the financing component, it changed. So one is that interest rates has reached rock bottom and now is increasing. So that's changing. The second component is immigration. Toronto, like Vancouver, has benefited from immigration. Most new Canadians, when they come to Canada, they'd like to be in 2 or 3 cities in Canada. I mean, Canada might have a program to direct immigrants to PEI, for example, but most of them, 50% of them will end up in the GTA. type of thing. If not 50, 40% or 30%, substantial number will end up in the GTA. Now the problem with the fear of this thing with the war with Russia, China, India, that might slow down immigrants, the flow of immigrants. It's just because people now are afraid, saying, hey, look what happened to the Russians that went to Europe. Now their assets are frozen because of a war. What happens if we take tougher measures on China? What are we going to do with the Chinese money that's in town? What are we going to do with the Indian money that's in town? What are we going to do with the Middle Eastern money that's in town? Are we going to freeze those accounts? And certainly that could slow people from coming or bringing assets with them to buy these bigger properties. So generally the trend is at least looking to me at this stage a little bit negative. I'm not sure Toronto could face a different outcome than the rest of the province. Everybody wants to live in Toronto, as you know. Wherever I go, they refer to it as the center of the universe. So everybody wants to be in Toronto, but Toronto does not necessarily reflect real estate prices across the province or across Canada. I think there's going to be significant weaknesses across the board, and Toronto might not be able to escape it this time.
So Toronto real estate prices you think might hold, but suburban or outside of suburban real estate prices you think are going to show some weakness.
Absolutely, and Toronto, as I said, might not actually escape.
Right. Okay. And so, what about the stock market?
That's the interesting part, because the stock market is a leading indicator of what's happening, and we all know that the stock market has been down quite a bit since the beginning of the year. Totally reversal of almost what happened in 2021. Now it's an interesting point in the stock market because almost the worst outcomes have been priced in. So that's why I said for an investor, if you are at this stage still invested, that's a good place to be in. You don't want to be selling now. I always get the question, should I be selling? Should I move to cash? I say, well, if you're at this point where you are, this is not a bad place to be in, because the stock market as a leading indicator, we're looking 6 months, 12 months ahead of time, and it's pricing all these things that we talked about now here in this thing. It's just what is unknown that the stock market has not priced. For example, would China enter this war in a more serious way over Taiwan, for example? Would this complicate matters? Would the G's, I'm going to call them G5 now, because there's no longer G10 and OPEC Plus, and Russia's no longer part of OPEC Plus. All these old names and acronyms no longer apply. So we're not sure what we're going to call them. But if things get complicated and can get complicated very quickly, the stock market could drop another 10, 12%. In fact, that's in our writing at that time. We said the market is going to drop around another 10, 12%. And since then, the market is down about 5%, halfway through. That's where we think the natural equilibrium is going to occur. But you are in a good place in the market for now. And if you have cash sitting on the sideline, probably it's the best time to start deploying some of this cash to invest, because you want to buy low, sell high. You don't want to be selling low and buying high. Like you have to be very careful with that implementation strategy.
Okay, and what about Canada versus US versus emerging markets?
Well, I think emerging markets will be challenged over. We've exited emerging markets probably, I'm going to say 2020. We barely have anything in emerging markets, or even in China. Brazil, Russia, India, China. Before this war, we've exited all these positions because we think there's a change in regime and philosophy, whether it's the Democrats or Republican. It doesn't matter. It's just you're hearing the message by a different voice or different way of communicating, but the regime change is occurring, that they are no longer interested in globalization that benefits China and India. The gap is getting smaller and smaller. The income gap is also improving in those countries, and they're becoming competitors globally for us. As you know, China now builds airports in Africa, and Russia has projects all over Africa and the Middle East. And so they're now becoming competitors to the West. So the change in regime is we're no longer interested in, at least how it seems, helping out or investing in these markets. So Brazil, Russia, India, and China are under significant pressure in terms of emerging markets. So we've exited them long time ago. Trump was very clear, and we read it that this is not a Trump strategy. This is not a Republican strategy. This is not a Democrat. This is a U.S. strategy, a change in regime and philosophy. So that's why we don't have any of these positions since that time. And I think it's going to be challenging, but doesn't mean it's not going to be challenging for also North American companies. If you do read, every company is revising or adjusting their guidance for the future, lowering their guidance on revenue and income, because they know they have to start now allocating more money to building facilities or infrastructure to take over some of the productions that are occurring in these countries. So everybody is lowering their sales, and everybody's lowering their net income because of that. If you're not going to be producing most of your chips in India or China, you're going to be producing them somewhere else. Ukraine would have been actually a great place to build in, because it's an ally of the West, as you know, from the reaction, and it's a technologically advanced and relatively cheap economy. But now Ukraine is shut down from the West to use as a substitute to India and China. So now that door is closed. So now where do we go? So domestically, we know what the average wage in Canada is relative to what it is in China and India, and that model doesn't work. Your iPhone that's now well over $1,000 is going to become $3,000-$4,000. That's the reality of it.
So if that's going to happen, how do you possibly get inflation down?
Well, that's why the markets don't believe that the Feds have the proper tools at their disposal this time around to affect inflation. Where they think is, it's me and you replace the phone every 2 years, the cycle will become 3-4 instead of 2 years, and so forth. Everybody replaces the car lease. You're given the option 3 or 4 years. Now it's going to become 4 or 5 years. So that's how there's an adjustment process that could possibly occur.
But that also leads to recession, because there's far less demand. There's half as much demand.
Absolutely. And if you take a look at the price of Apple as a company, as a stock, has not been doing well, because everybody's saying, so does Apple executives, how can we sell more iPhones, and how can we sell them at the same operating profit margin? The formula is not going to work. So everybody's revising their numbers down, even though they tell you, Russia and Ukraine are not a major portion of our business. That is true. But the rest of the formula negatively affects them in terms of their operating profit margin and cost of developing that phone. So everybody's doing that. It's already factored in, and other than government finding subsidies for productions, I mean, we've done it here in Ontario. Whenever we had a car manufacturer wants to build a facility, governments in Ontario or Quebec will
jump
always
in
grants and jump in and cut checks, 600 million, 800 million. And it's a subsidy in a sense.
Yeah. Well, in the Great Reset, you talked about government debt. So maybe we can take a break and come back and talk a little bit about that. Stay with us, everyone. We're going to take a 2-minute break for some messages and come back with Hussein Ahmed of Yorkville Asset Management in just a minute. Stay with us, everybody. Welcome back, everyone, to the Brian Crombie Radio Hour on Saga 960. We're chatting tonight with Hussein Ahmed. He's the founder and CEO of Yorkville Asset Management. We're talking about the market and the economy. And Hussein, you were just talking a little bit about government subsidies to car manufacturers. And in the paper, The Great Reset, I think you talked about debt, and that debt had increased fairly dramatically with a lot of not only governments, but governments and private individuals and businesses. How do you see that playing out, given your prognosis for the economy?
Well, when we talked earlier about inflation, actually inflation is driven by multiple things. One of them is supply, one of them is demand, but the third is the act of printing money. And we all know during COVID, Canada and the US and the UK and major economies printed actually more money. They pumped more money. They were cutting checks right, left, and center, making sure that corporate America does not default on its debt or result in massive bankruptcies. And that printing of money by nature, money supply and money demand, where they intersect is the price of money, which is inflation and interest rates. And as a result of printing more money, inflation is naturally higher. So there has to be two things that happen. They have to collect that money back. They have to get it back. So one of the things that you're going to start seeing, which is, again, in the article, I say it's unfortunate sequence of event, that now you have to take this money back. And how do governments take money back?
Taxes.
Taxes. So you're going to see taxes increase across the board. We've seen here taxes on luxury items. We've seen taxes on alcohol, tobacco is increasing. So taxes across the board are going to increase. That's one way. But beyond a certain level, where can they get this money back? They have to take it back in terms of higher interest rates. Higher interest rates is how they get money paid back, because the government is the ultimate lender. The government lends to Canadian banks. Canadian banks turn around and lend that money at a spread. So that's the other thing. So the natural thing that's going to happen, that's the reality. The problem normally in a recession like this, you want the government to be in a position where they go into deficits. You want them to go into deficits in period like this, but they're already borrowed to the max. And if they do borrow more or they print more money, that means inflation is going to stay higher. So everybody's caught in this. How do we resolve it? It's not an easy solution. Nobody has a solution to it. Unfortunately, it's a pain we all got to go through. You might go through it differently than person A versus person B. Person A, who might be wealthy, might not be affected the way person B is, but he's going to pay more for that car, for more that boat, for more any luxury item he does, versus person B is going to be higher interest rates, and his marginal tax rate has to increase at some level. So that's the sad reality of it. So it's the sequence of events that's really unfortunate.
I saw an article that there was a huge amount of savings, excess savings in Canada, that during the pandemic, people didn't spend a lot of money. They stopped traveling. They stopped, going out for dinners and things like this. And so there was, I think it was $350 billion of excess savings or something like this. And that people have started spending it now, traveling, buying airplane tickets, and you can see that the airports are jammed full, and we can't hire people fast enough to deal with them at customs and baggage handling and things like this. And the airplane stocks, I think, have done well, and the cruise lines are starting up again, and hotels are filling up again. Doesn't that spending, number one, it might add to inflation, but doesn't it keep us out of recession?
That savings is artificial, first of all, because even if they save 350 billion, there's equally 350 billion that were lost in the markets the past 5-6 months and more. Yeah, that if you take a look at the drop in the TSX, it adds up. Just people don't see it because it's in their RRSP. Your net savings have dropped. So maybe your cash account, because you didn't go out to restaurants, you didn't have to buy suits, you didn't have to buy your train tickets, your cash account is probably healthier. But if you take a look at your entire finances, you're actually poorer than what you think. I mean, your RRSP is down 10-15%, which is the majority of our savings are in RRSPs. Yes.
Okay.
So I don't think that saving. I think the saving grace in this is the transfer of wealth from one generation to the next. And when we talk about the transfer of wealth, so you're absolutely right that there is a solution in this. The transfer of wealth, when we talk about it, people assume it's a billionaire or a multimillionaire dying and passing his estate to his kids. No, there is a lot of hard working in middle income families that own property in Toronto, that they've lived in the property for years, and they bought it for $150,000. That's now worth $2 million. And that $2 million is going to pass at some point in time to the next generation. That is the true savings, but that's the problem. Government does not control when this estate transition going to occur. We don't. But the actual savings, I don't know if you take a look at your saving or anybody, they're down in general. My cash might be healthier because I can tell you I don't go out anymore. I don't have to buy these nice suits that I need to dress up for meetings. Yes, I feel my cash account is higher. But if you take a look at my RRSP across the board, look at all the funds across Canada, they're down 10-15%. Yeah, in your largest, other than your house, the next bucket would be
Okay. So coming out of the Spanish flu, 1919, we had the Roaring Twenties because there was so much pent up demand. It was not just the Spanish flu; it was World War I as well. But there was so much pent up demand that people went crazy and spent like crazy, traveling. We had major social changes. The end of prohibition. It drove just a boom for 9 years until the Great Crash. You don't see that happening again.
No, it could be possible. There could be something that changes fundamentally how we look at things, whether it's a technological innovation that improves efficiency, and efficiency is another component that brings down inflation because you use less to produce more. So there could be this. Like if you remember, what brought down inflation in the early 2000 was the internet. People don't think about it. Technological innovation made communication easier and faster, and inflation meant technology meant we do more with less resources. Everybody started having a computer on their desk in 1995, 96. So that brought also inflation down in the late 80s. People don't think of that they think inflation is just driven by interest rates, but efficiency is key component of driving inflation. So there could be things that drive inflation lower. I'm not saying that it's not, but normally these things do not occur. We don't wake up tomorrow and we find it in the news. Normally it takes months of work.
Well, and
government support and all that.
I can't remember who it was, but the World Bank or the IMF came out today and said that they expect stagflation. What do you think the risk of stagflation is?
It's relatively high. I mean, by definition, it's a recession with high inflation, which normally should not occur, because a recession means people are spending less. So normally it's deflationary. Here, what you have is a recession with inflation remaining high. The reason it's high, because we all know how sticky prices are. Canada is an oil-producing economy. We export oil, and take a look at the price of oil at the pump. It's not any lower than it is in countries that import oil. It is something, whether it has to do with a weak infrastructure or the tax system or poor management, the prices are sticky. If the price of oil today is 119, if it drops to 110, the price at the pump would not drop by that percentage. It's sticky. So that's the issue, because we have massive global supply problem at this moment. So it's a high probability that could occur, and it's a worse outcome. People are afraid from it way more than a recession on its own, because we tend to come out of recession relatively faster.
And I think that's what whoever it was, the World Bank or the IMF, that came out with this prediction today of stagflation, said it could last for a while, and went back to the 1970s and said the problem is that we've got multiple shocks. We don't just have one shock, we have multiple shocks, which I guess is what you've been talking about in regards to globalization dying, inflation being high, supply chain problems, the BRIC emerging market issues, etc. So what's the solution? If you were governor of the Bank of Canada or head of the Fed or Minister of Finance or Secretary of the Treasury, what would you do?
I think they're on the right track, raising interest rates at an accelerated pace. I think that they have to manage how they communicate it to everybody so they don't cause a crash. If you lose 10% in 6 months, you will feel differently about it than losing 10% in one day. That's the idea. And also at the same time, not everybody's losing 10%. It gives market participants a time to shift. So everybody last year was heavily invested in technology. Today, everybody's heavily invested in resources. So we've added commodities, for example, to a lot of our portfolios. And that's what they're trying to manage is, look, you're going to have these situations. So structurally, you shouldn't be in these businesses. These are high risk. They don't make money. When risk is off, you really need to be in these areas. So that's what central banks are doing, or else they would say 1% would raise interest rates. But that could cause a shock to the system. Markets drop 20%. Investors don't like losing 10, 20% in one day. But over 7-8 months, as we transition, some portfolio managers or investment managers will transition faster than others. So kind of you smooth out that impact of that shock. And that's what they're trying to do. And I think they're on the right track. Where it's the Canadian consumer that's being unrealistic. assuming everything is okay. You know, life is going to continue as it is. My suggestion, no, you're going to pay higher tax bills. Everything you pay for is going to become more expensive. When things go up, they rarely go down. And if they go down, not to where they were. We've never seen it in our lives where things go up from $1 to $2 and go back to $1. They go from $1 to $2, then to 1.7, and they stay at 1.7. That becomes the new baseline. So I think the consumer has to increase its savings, have to monitor their investments more carefully than before. You can't just put your money in an ETF and let it do its course. You have to be very careful with the investment managers you choose. Make sure that they have the right levers or the right strategy, that you agree with them or they have a convincing argument. But, you know, I mean, we have a Bitcoin fund, for example. It's a Bitcoin blockchain fintech. And the reason we expanded it from a Bitcoin, one of the reasons is regulatory, but the other reason is we thought just being in Bitcoin, it's actually at the highest risk level we're entering. It was launched last year. So we expanded it into that whole area of technology, blockchain, and fintech to make sure that if the correction occurred, and at that time we did not know, that the impact will be softer on our fund than it is on Bitcoin. So Bitcoins are down 60, 70%. Our fund is down 17%. You know, that's what we have to manage, is we have to make sure we lose way less than the market. Unfortunately, everybody's going to lose, but lose way more. And on the way up, we participate like everybody else. So that's kind of the winning formula we're trying to achieve.
Sounds like we're in for some turbulent waters.
Well, I think we're close to the end of it. I think June 30th is the end of second quarter. We'll start hearing back from companies in July and August. Summer tends to be a quiet month from seasonality. September tends to be a very good month because people come back from summer vacations and they're more interested in the stock markets, and everybody's excited for the fall and the winter and the holiday season, you know, back to school. There's so many good things that could come at the end of the summer. But I think we're if you think the shape of the U and in the stock market and where we are, we're close to that bottom of the U. So
I think we're at the bottom, but not in the economy. We haven't entered into recession yet.
You got to remember, the markets are probably 6 months to 18 months ahead of the economy. So the markets have already priced that in.
The markets have already priced in a recession, so the recession is going to come in 6 to 18 months.
Yeah, anytime it's occurring now, probably already. There's a recession in the US. I mean, and it's going to get a little bit worse as we go forward, but the markets have already priced in. So you got to remember, when you look at the markets as an investor, you need to look at not what's going to happen tomorrow. You're going to say, where is this company going to be in 18 months? If there's a recession, then that's maybe not that company should not be invested in. Maybe it's another company. But if you think that will be the end of the recession and interest rates is leveling off and maybe dropping, well, maybe that investment is worth entering into at this moment in time. So that's the decisions, where these things are going to be 18 months from now, not where they are 1 month or 30 days from today.
Hussein Ahmed, founder and CEO of Yorkville Asset Management. Thanks so much for joining us today. Really appreciate it.
Thank you, Brian. I appreciate the time.
Thank you, everybody, for joining us.